Hello, my name is Arawa Morontoduajalade, and welcome to my FIN 610 Financial Management in Organizations Unit 7 presentation. Eli Lilly versus Novo Nordisk, Leverage Macroeconomic Risk and Long-Term Viability Analysis. This presentation builds on the Stage 1 written analysis of Eli Lilly and Novo Nordisk. After summarizing the key financial findings, we shift focus to what has been identified as the most compelling analytical thread: Eli Lilly's elevated financial leverage and what it means in a macroeconomic context. Specifically, how changes in Federal Reserve interest rate policies could significantly influence the company's future financial performance. Highlighted here are the core financial findings from Stage 1. Eli Lilly delivered exceptional revenue growth, strong gross margin expansion, and a sharp recovery in earnings per share during fiscal year 2024. Two figures, however, frame the rest of this presentation. First, the company reported a debt-to-equity ratio of 4.52, which is roughly twice the level of Novo Nordisk. Second, interest expense reached $781 million after increasing more than 60% year over year. Together, these numbers indicate that Eli Lilly's future financial performance is closely linked to the direction of interest rates. Eli Lilly entered fiscal year 2024 with a total debt load of $33.6 billion, including $28.5 billion in long-term debt and $4.3 billion in short-term commercial paper, whose interest rates change over time. This commercial paper currently costs Lilly 4.61%. Interest expense increased 60.7% year over year to $781 million. Although interest coverage of about 16.5 times is still strong, the rapid increase in debt over the past 2 years means that Federal Reserve interest rate decisions now represent a direct financial risk for Lilly. Novo Nordisk, which carries roughly half of Lilly's leverage, is far less sensitive to interest rate movements. In a Federal Reserve rate cutting environment, Eli Lilly's high leverage shifts from a potential liability to a source of amplified financial upside. The most immediate benefit will come from the $4.3 billion in floating rate commercial paper, which is short-term debt whose interest rates adjust with the market conditions. A reduction of 1 percentage point in interest rates would lower Lilly's annual interest expense by roughly $43 million, and that savings would flow directly into net income and earnings per share. Refinancing upcoming debt maturities at lower rates would extend these savings over multiple years. Lower interest costs would also help Lilly maintain or potentially exceed its strong fiscal year 2024 return on equity of 74.2%, while narrowing the net margin gap with Novo Nordisk. Cheaper borrowing would support Lilly's acquisition strategy, allowing the company to pursue growth opportunities with less dilution to shareholders. In addition, Morgan Stanley has noted that biopharmaceutical companies have historically performed well during periods of Federal Reserve easing, which supports the potential for stronger equity valuation. In a rising interest rate environment, Eli Lilly's leverage becomes a meaningful financial headwind. The most immediate pressure point is the $4.3 billion in commercial paper, which is short-term debt that resets to current market rates. If interest rates rise by 2 percentage points, Lilly would face roughly $87 million in additional annual interest expense, and that increase would reduce net income directly. The company also has more than $5 billion of debt coming due within the next 12 months and another $4.1 billion maturing through 2027. All of this debt must be refinanced at prevailing market rates, which could be higher than the current range of 4.5 to 5.2%. If total interest expense moves toward or above $1 billion, net margins could fall sharply from fiscal year 2024 levels. Higher rates also affect Lilly's valuation. Because Lilly trades at a premium based on its growth expectations, increases in discount rates reduce the present value of future cash flows and compress its equity multiple more severely than companies with lower leverage. Novo Nordisk, which carries a more conservative debt profile, is less exposed to this valuation pressure. Together, these factors show that rising rates could challenge Lilly's earnings margins and market valuation at the same time. Expanding beyond Federal Reserve policy, Eli Lilly operates within a broader macroeconomic environment where leverage magnifies the impact of every external variable. The Inflation Reduction Act's pricing negotiations threaten the revenue base that supports Lilly's $33.6 billion debt load, creating pressure on future cash flows. A strong US dollar, which often moves in tandem with higher interest rates, would reduce the value of foreign earnings when converted back into dollars. Manufacturing capacity expansion also requires significant capital, and the cost of that capital is directly tied to the interest rate environment. The company's pipeline provides an important counterbalance, since positive phase 3 results can strengthen investor confidence and support valuation. However, upcoming patent expirations could reduce cash flow at the same time Lilly needs liquidity to service debt and fund growth. Taken together, these factors make the Federal Reserve's policy path a central influence on Lilly's financial outlook through at least 2027. The final verdict is a positive long-term viability rating for Eli Lilly, with leverage identified as the central variable that shapes the strength of that conviction. In a Federal Reserve rate-cutting environment, Lilly's high leverage amplifies the upside. Lower interest costs, expanding margins, and more affordable financing for acquisitions could lift performance well above fiscal year 2024 levels. In a rising rate environment, the same leverage amplifies the downside by reducing earnings, increasing refinancing costs, and placing pressure on Lilly's valuation premium. The bullish foundation remains solid. Lilly holds a dominant position in the GLP-1 market, which is expected to reach between 130 and 150 billion, and it maintains a strong pipeline and robust cash generation. However, the recommendation must be paired with ongoing monitoring of the Federal Reserve's rate path and Lilly's quarterly debt metrics. These macroeconomic factors provide the broader context that completes the analysis. Thank you for joining me for my Unit 7 presentation, Eli Lilly versus Novo Nordisk, Leverage, Macroeconomic Risk, and Long-Term Viability Analysis.